I like multifamily, not because I think it's a perfect asset class today, but over the next several years, we've seen construction starts drop. So for the audience, construction starts, we see about 2 years ahead of what inventory is hitting the market. We know that right now, massive amounts of inventory is hitting the market and drop things like, rent increases, et cetera. But over the next few years, and especially over the next decade, I think multifamily, it's so propped up by the government. It's such a preferred asset class by government, investment and agencies and debt, et cetera. I think that's going to do well.
Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Mettle. I'm here today with Nic DeAngelo. He's a powerhouse entrepreneur who has built and exited several multi-million-dollar companies in finance, economics, and e-commerce. But today, he is the president of Saint Investment Group. He's currently focused on high-return real estate investing with a specialty in large-scale distressed asset acquisition. This is going to be a really interesting podcast because this is something that I've dabbled in myself on a micro level, and Nic is doing it at a macro level on a really big scale. And he's got systems and leverage and relationships behind him to help you figure out how can you get some fixed income returns without taking on a lot of the risks of doing these investments yourself. So Nic, with no further ado, my friend, it's great to see you. Welcome to the show.
Josh, great to be here. Great catching up with you beforehand. I'm excited to have some fun and talk about some investing today.
Well, let's just get started on, your background just a little bit. I want to know, you moved from e-commerce into distressed debt and real estate. How did that intertwine and work together?
So I have two interests that have been the backbone of my business, my business focus for my entire career. The startup world, so the entrepreneur side, very, very heavy, very down the rabbit hole there. And then real estate, the investing side, what to do with the money once it's on that piece. I started my career working with a couple small family offices. So I'm proud to say that I stood on the shoulders of giants from a very early stage. And then, I transitioned and worked with some e-commerce out of the gates, a company where I was one of the earliest employees. We worked through all the way. We ended up exiting through National Geographic as the purchaser of that. That was fun. E-commerce was great. It wasn't for me over the long term. That's what I learned at the end of the day. And then the other endeavors along the way, I realized, I had an ATM business that was great when I was a young man and I didn't have as many bills and didn't have as many responsibilities. I thought that was a great opportunity to get great returns, which it was at that period of time. But I learned very quickly the number one lesson was it did not have the ability to scale to the degree that I wanted. So really that all brought me back to real estate. And real estate, I think, is the biggest opportunity to scale for my interests and for my talent set and my skill set. And then, like you said, I found out that the niche I was most interested in, that I could add the most value in, was dealing with distressed assets, dealing with off-market purchases. And then really I found that most interesting was long-term investing, which I found fixed income to be the best solution to that.
That's a great background. And I think it's super applicable to our audience, right? We have entrepreneurs, we have medical professionals, doctors, dentists, and other high income folks that are very busy making those dollars. And they're also very interested in how to replace that active income with passive income. And what you have done and what you're doing at Saint Investment Group dovetails really well with our audience. So currently at Saint Investment Group, you're specializing in large-scale distressed asset purchases. I mentioned I've done it on a small scale, but let's just start from ground zero. What does that mean? What are you investing in? What is your security? And how do you find these opportunities?
Great question. So large-scale distressed asset, let's just break that down so that people know what we're saying here. Large scale, meaning we're buying in bulk. We're buying multiple assets at a time, often hundreds at a time, right? Distressed, meaning they're not sterling perfect assets out of the gate, right? If you're buying something in most market conditions, in most markets, especially, we're on the tail end, we're in the post everything bubble world that we live in today, right? Every asset was overpriced. The margins were very slim. Every single asset was priced for perfection. Meaning if
Yes.
there's a small bump in the road, you had big problems. You're seeing that in multifamily today. You're seeing that in many asset classes. I am not that guy. I will never probably be that guy that's willing to pay full price for an asset because I believe fully that there's risk associated with paying full price. Because when market conditions go south, like we're seeing, you have no real margin of error.
Yep.
So we buy distressed assets, meaning we absorb a period or we absorb known risk going into
Yep.
that. What we focus on today to, bring this full circle are mortgages that are backed by single family houses where they're either not paying or they have a rolling balance. Maybe they didn't pay during COVID for 6 months and now there's that balance that's attached to it. And we have the advantage of working with big banks because their business model is origination, right? They make those fees, maybe the first several years of mortgage payments that are almost exclusively interest, right? They pay down very little of the principal. So if those individuals start having problems along the way, they miss payments, they have a rolling balance, those banks, those big organizations, big institutions, most commonly will want to sell those off. They don't want to go through the foreclosure process like the post 2008 era, where all these banks basically had huge reputational risk, huge issues, huge compliance problems. So, very commonly, they sell to third parties. We're one of those third parties. That's kind of the business in a nutshell on the front end.
So let's just do a quick analysis. I'm a bank. I've made a bunch of mortgage loans and I am holding that debt, or perhaps some other institution originated the loan. I've bought that paper, but I'm servicing those mortgage debts. A tranche of that mortgage debt, let's say 5% of them, are my PIA clients, right? They're behind, they never pay on time, they're not paying their taxes and insurance, their escrow accounts are malfunctioning. Could it also be that perhaps something in the origination was flawed, like they don't have all the documents signed right, or there was a disclosure incorrect? Could that be part of the distress tranche?
That does happen, and we're comfortable with most situations on that. Although you start getting into really, really niche pieces of the industry where, no paper, no docs and play. We try to avoid things that are overly niche. We like that simplified model. I mean, our buy box is so tight at this point, Josh. We know exactly what we're looking for, the exact markets, the exact conditions. So that wouldn't necessarily fit exactly in our buy box, but that definitely qualifies as distressed. And that is common that you see in the market today being traded.
So that would maybe help me just to really visualize this. Give me just a rough outline of what is your ideal buy box.
So we keep it middle of the road because it allows us to access higher volume, a kind of a larger, we can cast a wider net. What
Sure.
we're looking for, again, we're thinking 10 to 20 years out, right? We're looking for the most secure asset class we could possibly find. We found that as single family mortgages, single family homes backing that up. We are looking for good chunks of equity, meaning the homeowner has a lot to lose if they don't want to just work with us and stay in the home and do all that. So we roughly it's about 39% equity that we build into deals. That's kind of our average hold right now. And then we're looking for owner occupied. We want individuals, we want families that live in the homes where this isn't just some vacation home or some, failed vacation short-term rental situation. We want to work directly with the people that we can keep in their homes and help them avoid foreclosure. And then most commonly, we're dealing with middle class, middle of the road, cookie cutter, white picket fence type scenarios because there's so many of them. You look at how many 3-bedroom, 2-bath houses there are in the US. I mean, that really, really, truly to us gives us the most opportunities for resale. It gives those individuals the best opportunity for refinance options, right? So we find that is definitely what we're looking for, average middle class, middle income, middle everything in the US. And then with good chunks of equity and then with owner occupied. That's what we're looking for.
So they have huge intent, and it behooves them to figure out and unwind whatever this delinquency is. And if the intent doesn't work, they can't get out of it. That you have an underlying asset that is very liquid because it's what everybody wants. It's not the $3 million house. It's not the $80,000 trailer park. It's the vanilla middle of the road asset you're going to be able to get out of. And when push comes to shove, they're going to be able to get out of it, right? They're going to be able to sell that property, high probability, where you wouldn't even have to go through with the foreclosure. Did I get that buy box right?
Absolutely. And the strength of the single family market is why we chose this, right? Because you're dealing with this unique market environment in the United States where roughly 98% of mortgages are 30-year fixed. Where else does that occur in the world? A 30-year fixed debt product tied to an asset class where roughly 40 to 45% of homes are owned by boomers. The majority of those plan to stay in there for the remainder of their lives, right? You're talking 10 to 20 years of stability there. You're talking, 20+% of mortgages are government backed, right? So there's just so many things that bolster this industry. And then we've seen, such a strong market underlying single family homes. The only issue with single family homes, even if it's an amazing market, an amazing asset class, which it is, I don't want to manage them. I don't want my team to manage those as individual investments. So the scalability that we found was investing in the mortgages behind them. And this is the route that we chose to, get a part of, a supported asset class by so many different factors.
Yeah, got it. Okay. So I'm thinking that my listeners are thinking these two questions, Nic. Question number one, why the hell would I want to buy a non-performing mortgage? Because there's got to be a lot of work and legal construct to get that thing renegotiated, a modification or what have you. So one, why the heck would I want to get in somebody else's rat nest? And two, why would I want to own a 5% mortgage and only make a 5% return? That sounds like a lot of headache for a little return. And I know because you've done the numbers on this, that some of your investment funds average 14.28% compounded returns. So somehow you're making a lot more return than 5%. So pull back the curtains there and help us understand those questions.
Those are the two best questions, period. So, so you nailed it, Josh. You know this. So long story short on that, the answer is one and the same for both. Okay. The reason that we buy distressed is because we get deep discounts. Right? Oftentimes we're getting, if you look at an average per tranche, we're getting 26-ish% is what we're seeing recently. Sometimes it's a lot more than that, depending. And then also we can change the return profile on the back end because and this is too much inside baseball, but it touches on your question a lot more. There's several numbers that we have to run, unpaid balance, but there's also legal balances, fees, other things associated that get dogpiled on top, et cetera, et cetera. And then we're also dealing with individuals that have missed payments. What happens when you miss payments? Your FICO score goes down. You're less creditworthy. These are all parts of the pie here. So on our side, is it a lot of work? It absolutely is. It absolutely is. But it also has higher yields on the back end. Very commonly, to give you, kind of like a very common example that we see to illustrate these points that we're talking through. Let's say someone has a mortgage. We reach out and we say, why aren't you paying? What's going on? You have so much equity here. On our side, it feels like you'd be crazy not to be making this mortgage payment and your rate is below market. So what's going on? And they go, well, look, my mortgage payment's $3,000 a month. I can only afford $2,500 or $2,200, right? Something that is a lot less than their current mortgage payment. And these are middle-class families. They don't have that margin of error that many others in the country have. So they look at that and we say, well, look, if we can get your payment, your net payment per month down to this level, does that solve your problem, keep you in your home, allow you to keep your family in your home, avoid foreclosure, et cetera? And they say, yes. And we go, okay, part of that process for us will necessarily be extending your mortgage by X amount of years, okay? That might include a rate adjustment higher because your credit's a lot worse than it was when you qualified for this. You've missed payments, right? So baking all that in, we're usually targeting a return of high teens, like 18 plus. Usually 20 puts us at about where we feel very comfortable. So we can offer those higher returns to our investors on that side. So that's a very 30,000-foot view of the entire scenario. But the goal is to keep them in their homes. Because if they can stay in their homes, we get the advantage of they either can refinance out of that later or they make their mortgage payments for 10 plus years at a time, 10, 20 years that are remaining there. And it ends up being a win-win-win where Our investors win by high returns. The homeowner wins by staying in their home and not losing out on that equity, average of 39% we're seeing right now. And then also the banks win. They get to just get rid of these mortgages. They get to go print more mortgages, originate more mortgages, and work with more new home buyers and refinances rather than do all the workouts that are kind of more our core competency.
Well, and banks also win because regulators are carefully looking at their non-performing assets. And if their non-performing assets relative to their deposits gets out of skew, they get in big trouble with their regulators. So you take a regulator headache away from them, replenish their cash so they can go print more money, as you said, and they can just say, we're just going to go back to servicing this 95% that are paying on time. So I want to drill down just a little further to make sure I got it. I think what I heard you say was approximately you're buying these notes at a 26% discount. So let's just say there was $1 million tranche and you're probably doing larger tranches. Let's just call it $1 million. That's $1 million in mortgage indebtedness across, let's just say it's 10 different loans to make it easy, but you're not paying $1 million for 10 $100,000 notes. You're paying 740,000. So you've already got an outsized return because you're making interest on the $1 million, but you're only paying 740. So that's number one, how you're paid, right?
Correct. That's
then
correct.
you're going to go back to them and say, hey, let's rewrite this note to a 30-year term or an interest-only term or a 40-year term, and the rate's going to go from 5 to 7 or whatever, or maybe it's 10%, but your payment is going to get down to that $2,200 that you need so that you can be on time. You can start rebuilding your credit and you don't have to exit this home that you want to retire in. Did I get that part right?
Correct. That's a very common scenario. That's
your second lever of profits in this thing. And then the third lever of profits is attorney's fees, late fees, delinquency fees. If you dig into these notes, once somebody gets behind, you're paying penalties on principal and interest and on top of penalties. And these things can kind of it's like compound interest working against them or working towards your return.
Yeah, exactly. Yeah. So there's all these other, so we, just to give you the terms behind it, the industry terms, and you know these, right? But it's unpaid balance. So when you say, hey, there's $1 million in unpaid balance and we're getting a 26% discount on average, that's what you're looking at. And then there's usually additional fees and things that are tacked onto these where we can discount, et cetera, or they could get baked back in, things along the way. And then also there's an amortization schedule that also typically gets reset along the way. So between all of those, and they're all sliding scales, and we try to customize it what's best for the homeowner to get them on track and paying and meeting their financial payment ability. Between those, that's where we're usually sliding those scales to make it work for the homeowner.
That's great. That's great. Okay, so that makes total sense to me how you can buy a 5% mortgage and as you're online, your representation is tranches as high as 14.28%. Like that makes total sense to me. The question I would have for you, Nic, is what does that look like from you and your team in terms of having those individual conversations with all those people? How does that look? What does your team look like? I mean, I'm assuming you have attorneys involved. Are you doing modification agreements or are you doing full refinances with new disclosures for these people? What does that look like?
Typically, it's a loan modification process. So one of the ways that we add value to the process is the fact that 50 states have 50 different sets of laws, okay? And some are a lot better and some are a lot worse. That's just the nature of the United States and states' rights. That said, it also is an advantage for us because it's very difficult to navigate. Yes. So us having relationships with attorneys that are very close with the local jurisdictional laws and not just state by state, but sometimes it's county by county. It gets that complicated. That is a niche and a opportunity that we have to lean into very heavily. So when we have conversations and work through them, the truth is it's across the board. We have some people that say pound sand, I'm never paying that, or well, I'm happy to pay, but I can only afford $500 a month instead of 3,000. We've heard everything at this
Right.
point. And I'd say that our least favorite outcome is the foreclosure outcome. My background is from distressed asset purchases. I used to be the guy that bought at foreclosure sale. So I was the end
Ah,
buyer. So I didn't like that route as much, although there was good opportunity in the post 2008 world. I like the part where we get to keep people in their properties, but they have to also meet us halfway, right?
right.
So the discussions are all over the place. The compliance is crazy. Yes, 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 and to all of it. But at this point, we've been doing it for a very long time. I mean, I've been doing things in this distressed asset world since 2009, 2010, right? So we're familiar with it. We have our attorneys in place. And at this point, our goal is to keep people in. And we don't feel a lot of resistance from people on that because property values. I mean, here's the alternative, Josh, because economics, personal finance, it's all about alternatives. What would you do in other cases, or what would be the opposite? If you look in the last 5 years, right, the post-COVID world that we're in, mortgage costs have gone up over 100%, right? We have property values that went through the roof. We have mortgage rates that have over doubled.
Yep.
We have these crazy, crazy, crazy amounts. So if you look at over 100% is the alternative. If they go buy a house, they're paying significantly more and they
Mhm.
lose that the equity that they have in their property. It's in their best interest to work together. It's in our best interest because it gives the fund cash flow for a long period of time. So it really is one of the few things that I found that has a very net win-win perspective, but they also have to understand the market. So we'll give them, hey, here's comps in the area. Here's what a mortgage would cost on a comparable property today. Here's what that process might look like. If your FICO's this, which we know, then this would look like that. So it's just trying to give them resources and then allow them to make the best decision. And then us trying to make it so that the best decision is very easy for them. That's really where we break it down.
I love it. I love it. All right. So we've talked a lot about, I think, the investment vehicle and how you make these outsized returns. Let's talk about it. Let's shift gears a little bit and talk about it from the perspective of the investor. So I am now someone that is very interested in diversifying my assets away from the stock market, or maybe I've been in bonds, or maybe I'm just super conservative and I've enjoyed this 5% interest rate environment in money market accounts, where some money markets have been 4.5 to 5%. But now I'm kind of seeing, well, rates seem to be coming down. If the economy slows, we go into a recession. That means the Fed's going to be forced to drop rates. The stock market's not going to do well. My money market account is not likely to yield 4.5%. I want to diversify. Okay. So I'm that person. What does it look like for me in terms of dollar amount of investment? What due diligence and security am I provided with as an investor? And how long is my money tied up? And then, I pulled off of your website 14.28%, but maybe you have different investment opportunities with different time periods and different returns. So walk me through what it looks like for me as an investor.
Absolutely. So to expand on what you said, because I think it's actually really important, is what environment are investors in today, right?
Yes.
We're dealing with high volatility in the stock market. And by the way, Josh, I geek out on economics. It's one of my favorite things in the world. So we do 1 to 2 hour webinars on all kinds of topics along the way. We just did one on the stock market. Here's what I'm seeing, okay? Since 1995, the number of companies in the stock market has reduced by over 40%, okay?
Hmm.
I'm seeing that the top 10% of companies represent 75% of market value in the stock market. These are scary. And again, I could go all day on this. These are scary numbers. When you look at Goldman Sachs, when you look at who is the other one? JP Morgan, right? These are big, big names, or excuse me, Morgan Stanley. Between those two, they're estimating over the next decade returns of 0 to 3% per year in the stock market, right? Morgan Stanley and Goldman Sachs. I look at this and I say, this is a tough time for investors because back
Yeah.
in the day, there was so much capital, rates were low, everything was pumping. We were in the everything bubble. Now we're at a point where, we have high interest rates, but they look like they're coming down, right? But we also had, at the last CPI reading, inflation on the way up. So if we have inflation approaching 3%, and let's say they're lucky and they're getting 4% on treasuries, your net margin's 1% on that. Now, I already
Right.
told you I'm sensitive to margin. I think margin is a protection mechanism, right? I think if you're too close, you're cutting it too close for any bumps along the way. So it puts investors in between a rock and a hard place. Okay. So we've seen a huge increase in interest in fixed income. They don't have to go real estate, but I encourage investors to be checking out fixed income opportunities. There's a lot of great ones out there. So where we provide at Saint, our best investors along the way were saying, look, we want to stay away from equity investing. We want to stay away from the variability of a lot of investment models. Nick, what do you have that's more of a fixed income base? And that's really where we started growing our income fund. So our top end, like you said, for compounding returns, it's the 14.28% returns. That scales all the way down to 6%. Okay. And with different investment choices that they make. That the biggest choice on our side for our personal investment menu is the period of time, their lockup period, their initial term. So 6% for a 6-month term, all the way up to 14.28% return for a 36-month initial term. So we find that to be a very, very, very good balance of a shorter period. It's still not that 5, 7, 10 year like you see in many real estate products today, but it still has a pretty competitive return and it's fixed, right? So all that said, that's kind of where our personal menu shakes out. But I would encourage people to be looking at fixed income. I think debt's great in this current environment. I think there's a lot of opportunities there. But I just think the equity investing model is tough right now. Even the biggest names with the biggest analysis on the market don't have rosy outlooks. And the underlying fundamentals, I think, are less diversified and are more of a cause for concern than they've been in 30 years. That's what I see right now in the marketplace.
I think that's really well said. Really well said. Let's talk about number of dollars that need to be invested. Do you have minimum and maximum investment amounts?
Sure. Minimum is 50,000 for us. And then we don't have a cap on maximum. Obviously, if there's, when we start getting to, 8 figures, we want to have a serious discussion about kind of what their game plan is and their time horizons and their overall. But yeah, we can facilitate, very high end. Our largest level investors are in the 8-figure range, and our minimum is 50,000.
Got it. Very good. So what is the security instrument that I get as an investor when I put money into your fund? How am I protected?
So we have a series LLC. I like that model the best. So it's we do share classes. So the investments are backing up the investment, period. Right. So so what I'd say is for us to be in serious, deep, a serious, concerning place in the marketplace where we're having discussions about liquidation and how to pay investors out, I'd have to see a 40% discount in home values. I just don't see it. Right? I just don't see it. So that would be largely worse than 2008. And if you look at the underlying financials, ninja loans, the no income, no job, where people had 5 houses in 2008, it was a subprime crisis. I don't see those drivers today at all. So that's kind of how we break it down, is what would be worst case scenario. And really, I think 2008 largely was the worst case scenario in the real estate world. And I just don't see those fundamentals with Dodd-Frank and many of the other compliance expectations that people have today.
Yeah. And so when you have that LLC, when you invest in that LLC, the LLC actually owns the mortgage notes. Is that correct?
Correct. And we do have joint ventures. So it's a mixed model on that side, because there's times where a joint venture will purchase tranches, et cetera, because it might be working with investment partners that we have as well to purchase bigger tranches at that time. So it's a mixed model.
Walk me through like one of your funds where, what is its size? What percentage do you own, or does Saint Investment Group, which I'm sure has LLCs underneath it, what percentage is shared? Like, what does that normally look like?
Oh, shoot. I'd have to really dig into our,
give me a hypothetical.
Yeah. So very commonly it's a scenario where there'd be a big tranche of debt coming up. I mean, let's say 20 million, right?
Okay.
A $20 million purchase. And we would put in 7 figures on that. And then of that, we would basically carve up assets straight up. So it would be, hey, they're split up between the entities that are purchasing and the different operators that are purchasing it at that level. or it's, we manage those investments that are in that joint venture together and then split the returns accordingly.
Got it. So you're going to find other partners that may take a bigger tranche because the larger the tranche probably gives you the better economics in terms of discount. The larger the headache that you're getting off the hands of a big bank. But I'm going back to like, what's my security, right? Because my background is real estate and private money lending. So I either own title to the property or I have a note and trust deed against the property. And I know if the tenant defaults, I can kick the tenant out and I get the property. Or if the borrower defaults, I can kick the borrower out. But if I'm investing in your fund, the fund or the LLC owns a tranche of notes and trust deeds, or like, what is that actual security instrument?
So in that case, it would be that, we have a few purchase models, but so in the model that you said, right, where we use a joint venture in that case, there'd be an entity that purchases the assets, right?
Okay.
And we're investing into that entity with another group. So in that case, the entity that purchased the assets would hold those assets and we'd be invested into that entity.
Got it. You'd be a percentage owner of that entity that owns those assets.
Exactly right. Exactly right. And there's a few different reasons to do that, but one instance is that you can just buy larger pools rather than one-offs, or because that cramps returns, and we're looking for the ability to buy into opportunities that the average fund or the average group cannot afford or doesn't have the sophistication to manage. So that is a model we utilize. Absolutely.
Got it. Can you make investments into the different LLCs? Let's just call it Saint Investment Group. Can I make an investment out of my self-directed IRA or some sort of retirement plan?
Absolutely. That's what we see consistently as one of the best investment strategies, because like you said, up to 14.28% returns, that's a compounded return. So that's not a cash flow return, right? So in a 14.28% situation, you're getting a higher return by not receiving that monthly cash flow. So an IRA position is fantastic to utilize. Get the higher return, capture that in your IRA. It's an amazing strategy. We see it very regularly.
And do you have an ability to either get the compounded return, which just means you're reinvesting the interest, or take the distribution of the cash flow? Do you have both models?
Exactly right. So the sister option to the 14.28% return is 12% on a monthly distribution basis. So you get a higher return by taking the distribution option. So we find that it's more attractive for the IRA for people to be taking that compound strategy. And we recommend it anytime someone's looking at a fixed income investment opportunity, because it's very common to get a higher return for the compounding side. So if you're looking at an IRA investment, that's something to very, very much seriously consider.
So the ninja move seems to be fund a self-directed IRA, move some assets over to a self-directed IRA, invest in the compounding return so that you're receiving 14.28% compounded return, completely tax-free because it's in your IRA investment. Then once you're in retirement and you need the distributions out of it, then you can start taking the cash flow, the 12% cash flow, rather than letting it continue to compound if you need that for retirement income.
We see that very commonly. I think it's a great strategy. If you can add multiple strategies together, oftentimes you're getting the best of many worlds, right?
Sure,
the IRA with the compounding, with the higher returns. I think that's fantastic.
Yeah, because you're getting actually a 14.28% return rather than rather than paying taxes on that 14.28 return. So great. This is super helpful. Okay. You've done a really masterful job, Nic, helping me understand what is the investment opportunity, what is the collateral, and how does that really behoove an investor. Let's shift a little bit towards kind of like the macroeconomic landscape as you see it today. This has got to be one of the most interesting times to be alive if you're a student of macroeconomics and what's going on in the world. We're coming off of historically low inflation, deflation throughout COVID, and very low interest rates, to a very high level of inflation, not the highest ever, but in my lifetime the highest ever inflation. Now we're seeing inflation come down. We're seeing, as you say, the asset everything bubble start to right size a little bit. Now put on top of this, we have what Doge is doing to curtail and bring down government spending, which is going to bring down GDP. It's going to slow down the economy. And now we've got this, the tariffs and these potential trade wars. So how do you view all of that, and where do you see this going? Let's just say through the rest of the decade in 2030. Like, what's your base case on how all these things play out?
I love this question. Okay, so there's so much there. There's so much there, Josh. Let's talk through it because you basically hit all the highlights. That's where we're at today. I think the tariff question is very interesting. I'm more laissez-faire. I'm more libertarian by nature, especially economically. But somehow I ended up relatively pro-tariff. I still am not fully throwing my hat in that ring. But here's the decision, and here's like our analysis that we've delved deep on multiple things. Where were we at, right? Where were we at? You said it. Stagnant growth. Atlanta Fed is slowly ticking down our GDP numbers. We averaged 1.9% GDP for the last 10 years. We're below that. It looked even negative, right?
Yeah.
Then you take CPI, which is inflation. That's going the wrong direction. So we have growth on the downswing. We have inflation on the upswing, unemployment on the upswing. We have the stock market. If you look at the Shiller Cape ratio, they're estimating 38% overpriced today, right? That 10% is nothing compared to 38. And we're all worried about a 10% drop, right? We have real estate super high, we have rates super high, and we have record US debt with 2 trillion being added annually, right? That's where we're at. So if we do nothing, we have big problems.
Right.
I'm not saying I agree with tariffs. I'm not even saying Trump's approach to tariffs was exactly what I would have done or would have, but we know that we can't do the same thing. The same thing gets us real bad results because that's where we're at today.
We're speeding towards a concrete wall.
100%. And what we know is that just if you look at it in a bubble of the fact that unemployment's going up and inflation's going up, that's stagflation by definition. And anyone who peels back and looks back at the 70s and 80s, the stagflationary era, in order to break that, we had 20% rates. Volcker hiked rates through the roof. So where does that leave us? Is that a change is necessary. Volcker used the rate lever to take that to the moon, and that was his angle on that. It looks like Trump's leaning into the tariff side very heavily, very aggressively, pounding the podium over it. I think it's too early to tell, but here's what we've seen. We've seen countries already coming out. We've seen Vietnam. We've seen Japan. We've seen EU
Thailand.
yesterday. And this is in a handful of business days.
Yep.
Saying, hey, we're willing to reduce tariffs to zero. We're willing to work on this trade imbalance. So far, I think there's still a lot to be considered, and there's still a lot of this story yet to write. So far, I'm relatively optimistic about rebalancing that. Most importantly, those things are great. But most importantly, I think we as a country need to be bringing manufacturing and jobs back to the U.S. very heavily. And I think if we do that, and the last time we were the manufacturing powerhouse, World War II, took us about 18 to 24 months to build it out and basically be a manufacturing powerhouse in the world. I mean, I think we can do it again. I think we need to do it again, not just for, economic security, but national security to a degree. So I think we're setting the stage for that. Trump still, if he gets a win here, still has a lot of, different bridges to cross and navigate effectively. But where we're at, I think we absolutely needed to make a change. I think focusing on manufacturing at home is a both sides of the aisle issue. Biden had the CHIPS Act and very seriously focused on that as well. So I think if we remove the political rhetoric, it's something that's tolerated well on both sides to bring jobs back and manufacturing back. That's what I see. The biggest question that I have through all of this, because I'm obsessed with investing in economics, is what do we do about it? Where would we invest? How is this investable? What's the best play to invest in the U.S. or invest in this next round of economic things that we have on our table, like to make the most of it. How do we maximize that? So that's what I'm seeing in the market today. It is a very weird time, very politically divisive, but I also think there's a lot of opportunities for the country.
Yeah, and the other piece that we didn't talk about that I think plays into the White House's plan is that, the government owns 36.5 ballpark trillion dollars in indebtedness. 9 trillion of it needs to be refinanced in 2025. And the vast majority of that debt is like 1 or 2%. So the government has to refinance. They don't have an extra $9 trillion laying around. Unless they want to sell off, all the real estate they own, they're going to have to refinance that debt, and it's going to go from 2% to 4.5%. That is a huge increase in the cost to debt service the national debt. So I think what the White House is trying to do is exactly what you said. They're trying to bring manufacturing jobs. They're trying to bring economic advancement back to the middle class, not just Wall Street and white collar. And at the same time, they're willing to tolerate the pain that, as you said, this is going to take 18 to 24 months. And the pain actually serves Americans well in the fact that all of this turmoil and the slowdown in the economy will bring down longer term interest rates, and that'll enable us to the Treasury to refinance that debt at lower rates. So maybe it doesn't go from a 1% or 2% note to 4.5%. It goes from 1%, 2% to 3.5%. But a percent on $9 trillion, run the numbers. That is a lot of money that the Treasury would be saving.
Absolutely. Absolutely. And it's, you hit on GDP, and I think, you hit on unemployment, and you hit on, that there's big job cuts. These are massive. We're talking hundreds of thousands of jobs being cut. This is very real. This is very real. I want to point out the other side of the coin to consider, because 300,000 jobs, the government employs 20 million people. It's the largest employer in the United States is the US Gov, right? So their payroll, if you want to think of it that way, is not small, right?
Yep.
So 300,000 is a small piece of that, but 300,000 jobs going from government paid, AKA tax dollar paid jobs, moving to the private sector actually has the ability to create real, true GDP growth. Because we've talked debt. So if you're taking on debt to boost GDP, is that healthy? You know what I mean? It depends. It depends what your ROI is per dollar of debt that you take on.
But our level of ROI at this level of debt is very bad.
Exactly right. So if we can take jobs from the public sector and bring them to the private sector, then that actually has the ability to truly actually grow GDP in a meaningful, healthy way. And when we look at things like bringing manufacturing back, also ability to really move the needle on GDP in a big way. So I'm not 100% sold on tariffs. I would never, I was more laissez-faire, and somehow I ended up semi-pro tariff. But I would say that I think the opportunity for GDP growth and rebalancing our books as a country is something that we can't discount, and has been put off by the last 5 or 6 presidents to really get this in check.
So let's bring that framework back to the investment opportunities, which is you alluded to, Nick. Like, okay, how do we take this understanding of what's happening in the world and economics, and then how do we position ourselves, as Warren Buffett says, you want to find the investments where you have more tailwinds than you have headwinds. So you've got some options here, right? You've got the stock market, which, as you said, Goldman and Morgan Stanley are saying that you're probably going to get a 0% return, because we've seen 20% return years, and you have to revert to the mean eventually. You have leaving the money in money market accounts, which is great if you think that the Fed is going to keep rates at where they are. But I think Fed is probably going to drop rates as we see the economy slow down. So that's going to kind of dry up for you. You could buy a bunch of real estate, but I'll tell you, man, like, I've been investing in real estate for 25 years. We own over 100 properties, and I haven't been able to find shit to buy in the last couple of years. Like, I can't, it just doesn't pencil. Like, like you said, like, if I'm going to deploy capital, I would like to have a return on that deployment of capital. And with interest rates where they are today, it doesn't make a lot of sense. And prices are still, they've come down a little in some commercial stuff, but not relative to the amount interest rates have gone up. So that leaves you towards this fixed income idea. And just personally, Nick, I've moved a good percentage, like 5 to 10% of my net worth into private money loans. I'm taking it from a little different angle than you because I know real estate. I've done mortgages for 20 years. So I'm lending individually in my entity on real estate assets and taking the return. You're just doing it from the other side of the equation, but you're doing it from, if someone doesn't have the background that I have and doesn't have the capital that I have, you can get outsized returns. And it seems like a relatively stable asset class, all things considered right now.
That's the two asset classes. And Josh, I want to know your portfolio, man. I didn't realize you had over 100 properties. I geek out on real estate all day long, but the two asset classes that I think, I'll give you three. Okay. I'll give you three over the next probably 10 years that I think are really, really going to be winners.
I love this. This is pay attention, everybody. If you phased out, you want to hear this part.
These are my top three. I like single family mortgages, okay? Because I think the underlying asset class, we've talked about it, so I won't over drill down on the details. I think it's a very solid asset class. What to look for there is unemployment. Because when unemployment spikes, people don't pay their mortgages as much. That said, our portfolio I see as disproportionately protected versus the average market. I think you're going to be seeing a lot of FHA problems and early stage mortgage problems. But if we're looking at things that are much longer term, 10 plus years into their mortgages, a lot of those are more stabilized. A lot of those I have less concerns over. Our portfolio operates about 96.7% of on-time payments on average. So I'm okay with where we're at. And frankly, if you're buying distressed in the mortgage market, God forbid there's more foreclosures, it actually drives prices down for us, which increases our return. So I'm okay with that. That's number one. Number two is industrial real estate. I am very biased. Let me be the first one to say I am very biased to industrial real estate because that's my favorite asset class in the industrial sector. I also think the underlying fundamentals, if we're bringing manufacturing to the US and to our surrounding countries, Mexico's our number one trade partner, not China. Right? So if you look at nearshoring, southern US, there's strategies there. There's strategies throughout different parts of the US, especially for manufacturing. So if we're leaning into the manufacturing side on the US, which is both sides of the aisle, I like industrial real estate as number two. And then I like multifamily, not because I think it's a perfect asset class today, but over the next several years, we've seen construction starts drop. So for the audience, construction starts, we see about 2 years ahead of what inventory is hitting the market. We know that right now, massive amounts of inventories hit the market and dropped things like, rent increases, et cetera. But over the next few years, and especially over the next decade, I think multifamily, it's so propped up by the government. It's such a preferred asset class by government, investment and agencies and debt, et cetera. I think that's going to do well. Those would be the three that I think are the shining stars. That's what we're leaning into over the next few years.
I couldn't agree with you more. We do a presentation called Demographics or Destiny, and we break down the demographic size of the millennials and Gen Z, and you look at the number of people, and you can see that millennials, as they get older, as they move from, let's call it 30 to 40, their home ownership percentage goes up. And you can see, we're just starting to see this with Gen Z as they're becoming homeowners. But you can forecast the number of inside those cohorts. And then you can forecast as they get older, the number of people who are going to become homeowners. And then you overlay that on the number of housing permits and housing completions. And you're going, we're building 500,000 homes too few each year. And play that out over the next 10 years, simple supply and demand. There's more demand for housing, apartments, multifamily apartments, and single family homes than there's going to be incoming demand. Demographics are destiny, and they're going to buoy home prices. Unless you have Elon come up with something where they can 3D print a home on site in 3 days for 50 grand. But, we haven't seen any real innovation in construction in over 50 years in this country. So I couldn't agree with you more. And from a hands-off standpoint, to be able to invest in an asset that's secured by those asset plans, but not have to do all the work and research yourself is a huge advantage. So, Nick, this has been fun. First of all, thank you for the rad conversation. And where do people find you? Where do they get a hold of your podcast that you mentioned? You do a bunch of writing and literature on the economy. Where can they find you?
The best place that we can give back to the investment community and they can learn what we're doing and what we're seeing in the economy. We do free webinars every single month. And the best place to find those, they're all for free at saintinvestment.com/resources. So
Right.
we've covered the stock market. We've covered, I love the demographics, conversation. We've covered some good things there. We're doing an upcoming one on stagflation. So lots of good deep dives, 100% for free. They can find that at saintinvestment.com/resources. And if they ever have questions about investing with us, they can find all the info there too.
Right on. Appreciate you, Nic. I'm going to leave the closing thought to you, and then we'll close out. Any last words of advice or wisdom for our audience today?
I would say there's a lot of chaos. We talked about a lot of that, Josh, at a very high level. And I would say there's also a ton of opportunity. Positioning well in this reshuffling of the deck gives investors a good long-term outlook, but there is tough decisions to make. So if they're willing to make the tough decisions, if they're willing to see what's going on in the marketplace, I think they can be positioned for a decade plus of really good opportunities.
Great advice. Thank you, Nic. Appreciate you being with us and sharing so generously today.
Josh, I had a great time, man. Let's catch up soon.